Hello, everyone. Once again, we're trying to bring you some data that will help you, some analysis that will help you, but in format of a presentation where we are trying to explain a concept. The concept is called correlation. We have, been talking about this concept on our group for quite a bit of time, but I think there are too many doubts on this concept with a lot of people. And there's, when there are doubts, there's also misinformation. There's also lack of understanding. We're trying to simplify this concept, give you an in-depth analysis what this concept means and how it will help you. So without further ado, let's go and check this concept called correlation. So what is a correlation? Correlation is, we'll talk about hypothesis first. The hypothesis is that it is a statistical measure to find similarities between two data sets. So when you have two data sets, like our outcomes of the strategy on a daily basis, these are two data sets. This outcomes on a daily basis is what we find a correlation between. And a high correlation means that the outcomes are very similar. A low correlation means that the outcomes are dissimilar. There is also a concept called extreme correlation, which is, there is a 100% correlation or a minus 100% correlation, which is not desirable. 100% correlation basically means it is essentially the same strategy or essentially the same data set. So every day, you'll have the same data. The variance or the standard deviation between the data will be less. In case of a negative correlation, the standard deviation, is equal to the sum of the difference. So basically, in that case, if a data set is showing plus 100, another will show minus 100. So there'll be a zero sum game. So ideally, when we do, let's say, correlation of a straddle with a long straddle, and the long straddle works exactly the opposite of the short straddle, it'll actually have minus 100% correlation. So this is a thing that happens a lot of times, that when a strategy doesn't work, many people say that do the inverse of it. एंड वो बेसिकली इन्वर्स करने का मतलब यही होता है कि उसको आप 100% नेगेटिव कर लो तो उसका उल्टा रिजल्ट देगा, तो आपको जो नेगेटिव आ रहा था उसको पॉजिटिव आ जाएगा. बट दैट इज एसेंशियली समथिंग व्हिच इज एन एक्सट्रीम थिंग. इट नेवर वर्क्स लाइक दैट. Ideally, we are looking for a correlation percentage which is between minus 40 to plus 40. Now, why minus 40 is because once you have a broader portfolio, you need something which will help support the a particular data set, which is in this case could be a directional strategy versus a non-directional strategy, that will help in balancing it out. So that's why negative will work. Ideally, people, when you have similar type of strategies, then you would want to have a positive correlation which is less. And when you do different types of strategies, then you would have to have a combination of low and let's say negative and positive. But eventually you would want to have a lower correlation of the sum of this. And this is what we'll try and explain. The concept is a very a concept that is there from a statistical point of view. Real world application is something that is done basis the data set, the understanding of the strategies, and the hypothesis behind it. When we make a portfolio, we have to choose these strategies. This is based on the correlation percentages as well as the fundamentals of the strategy. This is what I'll explain in the next slide. Before we do that, when we do this correlation, we basically do this correlation hypothesis in form of this percentage. So we talked about these percentages. So we'll come back to this slide again. But what I want to show here is that these are like our strategies that we have. Across it, if you see, the gray areas that are there across, this gray area, this is basically 100% correlation. So it is the same, exactly same strategies. Whenever we are closer to 100%, this strategy is, the two strategies would be very similar. So for example, zip and zip bnf, zip bnf is part of zip, so that's the reason my correlation is higher at 77%. While between zip bnf and zip nifty, the correlation is lower at 38%, which is a very interesting thing, and this is something that we will talk about, going forward in the next slides. But the idea here is that between these two strategies, there is a particular number which talks about a similar outcome. Similarly, when we see zip and zip nifty, the correlation is as high as 86%. But between something like a GMP and zip, the correlation is lower. Now, GMP is also two indices. Zip is also two indices, both the indices, and most of the times both will take the position same, but at the same time. But the correlation is much lower than what would be if in case of zip to zip, or zip to even zip nifty or zip bank nifty. And the reason for that essentially is because it's a different kind of instrument. So when we have different kinds of instruments, when we have different kinds of uh, you know strategies buying or selling, then the correlation will vary. And that's exactly what happens when we see a correlation of a directional strategy against a non-directional strategy. So most of the times, directional strategies will compensate for your non-directional losses, or non-directional strategy will compensate for your directional losses. This is what is the portfolio, how much you've allocated in that portfolio. Then across non-directional strategies as well, there are completely non-directional strategies, there are semi-directional strategies, and there are many, many other formats. And according to that, the percentages change. And this is exactly what we are trying to explain, and we are having this data for you to understand as well. You will observe it on a day-to-day basis when we show the result. So the results are that you see on a day-to-day basis of the strategies are beyond these numbers, but when you see these numbers, they will give you an objective view of the strategy's performance. So something like a TDS with a TMS, it has a high correlation at a 55%. With a TDB, it is a 58% correlation. But with something like a TPS, which is a different kind of a strategy, the correlation is lower at 13.41. So what does that say? That when you combine these two strategies, it'll actually have a good correlation. At the same time, this correlation can change over a period of time. So when we made TKZ, correlation between the two TDS and TKZ was lower. But over a period of time, when TKZ went into a drawdown, it was going to a similar way as TAD would go, or TDD will go. And that's why the correlation actually increased quite a bit. And then that's the reason why we also let the strategy perform before including back in the portfolio. So that is what we have done right now with the portfolio, with the strategy. Positive correlation is not bad. It is just that we need to manage it along with other strategies to have a let's say consistent result. In that sense, you can always go for strategies which are highly correlated, which would always mean that they will fail together, they will succeed together. So that's what the disadvantage of a highly correlated portfolio is. It doesn't have to do anything with the returns. It is more with the consistency of return, consistency of the performance, and that's what correlation is about. Our correlation data is based on live auto, so it's not basis paper trade, which in our terminology is more like a theoretical number. So paper trade doesn't account for slippages, doesn't account for anything. While we try and create a portfolio, we avoid looking at paper trade. We avoid looking at backtest. We would look into something like a live report, which gives us a better feeling of the slippages and everything, because all these slippages, or let's say even the errors that would come, are accounted in this live P&L. So it basically gives us a better flavor of what we are trying to do and what we are trying to achieve, because slippages will happen. The more you trade, you would realize that slippages are evident, and how we have to counter a portfolio's returns, or look into the portfolio's returns, is to consider the slippages that are there. So that's what we are trying to do here with this live data, and many of the strategies that we will launch, unless we have a 1 month data, we will not be doing it. Now this data is available freely and transparently on our Google Sheet, and it is updated regularly for this correlation. So now the thing that comes in is how are we creating these non-correlated strategies? Now this is an insight into what we are doing. So there's a risk in this that we are trying to explain too much here, but it is actually important for any user to look into it. There are three, four types of diversifications. Um, there's something that there was a share video that I shared from Square Off and Vishal Mehta as well, and they were also talking about this kind of diversification. They essentially talked about entry exit time diversification, but they also said of course there will be different type of diversification which I'm trying to expand on. And probably this is that video gave me the thing to also talk more about this correlation of strategies and non-correlation, how it can help. Actually, it came in from that video. So when we look into this exit entry time diversification, what does it mean is that we need to have some gaps between the entry times. What does that do? That will have different strikes available to us. Because generally when we do straddles, we'll basically use a ATM strike, and that strike could change in a volatile time. Uh, but in a 1 minute, 2 minute difference, maybe not. But when you have a 5 to 10 minute gap between two set of strategies, in that case, there is a highly likely possibility that the diversification will be there from time. That those we Some people talk about a gap of 20, 30, 40, 1 hour, 2 hour kind of a gap. We are essentially talking about certain set of strategies where we at least have 5 to 10 minutes gap. Some may say this is not enough diversification, but this is how it is for us. We have other types of diversification as well, and that's where something like exit time diversification will come in. So people were talking about only entry time. There's an exit time diversification. Something will exit at 2:30 to 2:45. Something will exit at 3. Something will exit at 3:20. Apart from that, we also have strategies which have entry basis other indicators which are apart from time. So they might also induce non-correlation in a sense. So something like a TDS has a additional entry condition apart from a time condition. So it will not essentially enter at the same time. TMS also has it, but only activates at certain times and certain durations. So this is how that entry exit time diversification would happen. The other type of diversification is indicator diversification. Now, when we talk about indicator diversification, there are many types of indicators. I don't need to give a lecture on those things, but we all know there are momentum indicators, there are trend indicators, there are price-based indicators, there are price and volume-based indicators. We are trying to diversify these indicator sets and different time frames to increase the probability of non-correlation. So when we have different indicators, they might speak differently, and at different time frames, they will definitely speak differently. And that's what we gain from having these different sets across strategies. So something like Zip and Zap are entirely based on different indicators. In fact, today Zip went short on Nifty while Zap went long on Nifty, and that is the kind of correlation we are talking about. This kind of diversification also helps in making sure that we don't have a shock on one of the days. Although if this trend, both of the set of indicators would find the trend is strong, we could have a shock if something goes wrong, something which happened a couple of weeks back. But that possibility is always there. But on a regular basis, we are trying to avoid it. On a long term basis, those probabilities are reduced. The other set is that when we talk about strategy or instrument type of diversification, this is something which I explained earlier when we were talking about the difference between ZIP and GMP. When you do a directional or non-directional selling or buying, you change the instrument from Nifty or to Bank Nifty to Fin Nifty or USD INR, whatever you do, it will also induce a diversification or increase the probability of non-correlation. This will help mostly into different types of markets, but this needs to be measured on a regular basis, because what might happen is sometimes Nifty and Bank Nifty would perform very similar, and the traps would be similar on across both. Breakouts will fail across both, but it needs to be observed quite regularly. Now, breakout will fail definitely if there's a Bank Nifty is part of Nifty, but then there is also a possibility that your losses would be less in Nifty, or your losses will be less in Bank Nifty, or bank nifty will break out or nifty will stay the same. So those kind of things would always happen, and that's again something that induces diversification. So when we talk about correlation, is a factor that is because of all these three types of diversifications that are there, and they bring about the difference in the correlation between the strategies and the data sets. So then it comes to what is the pro and con of incorporating a lowly correlated portfolio. Now, when we talk about these advantages, the biggest advantages is the stability in returns. It might not be the optimal return that you will get, because you might say that I want to do only directional. It will actually give you a better return, but it will not give you the stability in returns. It will have a higher P&L fluctuation, and the chances are that that you will have you might lose patience with it. uh, there are also less chances of all strategies failing together. If there's a market is directional, generally your directional strategies will perform and your non-directional strategies will not perform. It is also something which will help you understand your own portfolio, and it will help you scale up the portfolio, because as you scale up you would want more consistency, less P&L swings. So as you understand the relation between those strategies, it will help you do it. So ideally you should start with an uncorrelated portfolio, not like that for now my capital is 10 lakh rupees, I'm fine with it. Actually it starts from there, because all of us are trying to grow our portfolio, all of us are trying to increase our exposure or trade more with these algos, and that's the intention that we have got. You also have the advantage of getting a best of both worlds, so you can have a combination of directional and non-directional strategies, and eventually that will help you manage both the drawdowns and returns of the strategies. It is a long-term view of algo deployment. So again, this is a creative thing. It actually helps the creator. When we are trying to educate you, it actually helps us by the increasing the probability of you sticking to these setups, because when you look into it as a portfolio, your losses will be lower, it'll have less swings, and it'll be more comfortable for you to absorb the swings of the P&L as well. And the cons, again, when you do more strategies, of course the brokerage would be high. You can counter this by using a free brokerage or a low brokerage solution. There could be also higher taxes if you're doing variety of instruments, and number of trades are increasing, although, but generally when you're doing different types of strategies, the number of trades would be similar, unless you're doing something like a scalper, which is there to balance some of these things. So it is two ways. The costs would increase slightly when you do a lowly correlated portfolio and you do a combination of strategies. It is also a dynamic thing. It is bound to change, and you have to look into the data regularly. Example I gave you of TKZ and TDS. When it started, TKZ had a low correlation, but when it went into a drawdown, the correlation increased, and that's where we have to look into it and then take a call. Do we want to have that strategy as part of a portfolio, or we don't want to have it? So it may change. It may have happened that for last 2 months the correlation was higher, and then it becomes lower, or the vice versa. So we have to look into it dynamically. At the same time, the best understanding of this is actually coming from the strategy creator, because they are in full control of these parameters, and a user-driven approach may not help. However, uh, you know, uh, you know, we believe that we should share the data with you. We should give you this data and let you understand it and ask us the questions. What kind of correlation is there between two types of strategies? How we can balance and work around it. Correlation also doesn't ensure low drawdown, but it is a statistical method to reduce a drawdown. So it's a method, not a ultimate, tool that will reduce drawdown. It may not, depending upon the kind of strategies you are using. So that's something that we have to be careful about. So there are tools that help in correlation, which is allocation. We've talked quite a few times about it, and this is how you can have a look into this correlation part. So we've talked extensively about these kind of correlation and the allocations that you would have. So this is a chart that you have to look into. this is something you can use as a tool to put your correlation and allocation along with it. Anything that you want to ask as a question of regarding it, we can handle it specifically. But this is a chart that you should look into. We spend some time on it. And there's an example that I wanted to share with you, which was about a non-correlated portfolio or lowly correlated portfolio. We have some strategies, five strategies that we are putting it together, and we're showing this live data from 19th of May for these strategies. As you can see, this is TDS, TMS, TBAC on or TDB on as a scalper. TDD, Zip and Zap. This portfolio has a cumulative return of 23% since May, mid May. This is on live. This would have a low correlation given the set of parameters that we have. Although the market has been very difficult, but that has this portfolio has got a about 2.5 to 2.37% drawdown in this period, and we have been able to survive tough periods with mostly flat or slightly green ROI in the last 2 months. Um, when you look into this data, you would see that for till August it was doing well, and then since September and October, as I said, there have been tough months all across. It has been having more of a flattish kind of a growth, and that's what I was trying to explain. It will help you, uh, with the up ebbs and tides of the strategy to go about. If you look individually, something like Zap had a 22% drawdown last week. That drawdown was considerably reduced as part of the portfolio. So that's something that you can look into and have a look at that. This is also another set of data. I mean, the same, the strategies we have put in like weekly summary of data. Now, normally we don't look into this data very clearly, but what or very, frequently. What we are trying to explain to you is that let's say there's a combination of strategies. Now, something like a KMS on Thursdays has had a negative, you know, 49 rupees kind of a average P&L. That doesn't mean that it always does negative. Sometimes it will do positive, sometimes it will do negative. So that's where the data is left to interpretation. But when we see this as a portfolio, you will realize that all these strategies do very well on Thursdays as a combination, and that's again the whole thing about correlation. So when you have so maybe the correlation is higher just because all the strategies are performing on Thursday as well, but they are giving different results. So some might give a very high result on a Thursday. Some might have a flattish result, like over a period of time, like TMS has. And this will keep on changing, as more and more data comes in. Let's say TMS has data for last 6 months, and then TDS has the data for last 1 year. And then you see the difference in the data as well because market dynamics have changed as well. But when we see is that a correlation, it actually gives us a better understanding of the data. So that's how you can create your own correlated non-correlated portfolio. Actually, it should be the non-correlated portfolio, but or low correlated portfolio. I think we have missed a word here, but essentially the point is that we have to look into certain aspects of the returns, certain aspects of the relation between strategies to come to this calculation of correlation and the portfolio. With this, we've done with this discussion, and we hope this helped you in understanding the correlation between our strategies and how you can use correlation uh, for improving your portfolio in terms of your returns and consistency of the returns. uh, you can always come back to us, ask us any questions on our Telegram group, and we'll help you with this same thing. Thank you. Have a good day.